The Firm, India's only show on corporate law, tax and audit matters.
The Constitutional Amendment Bill for GST has not yet received clear passage. The draft GST Bill is nowhere in sight either. But over the last month, we did get the first glimpse of what India's GST architecture will look like. Hello and welcome to The Firm. Today I have with me GST expert and EY Partner Satya Poddar and two industry representatives, MV Narsimham of Dr. Reddy's and SM Kulkarni of Mahindra, to talk about how the GST plan is shaping up and whether there's a chance that India will make the April 2016 deadline. Satya, I'm going to start first with you to ask you what you make of the 4 business process papers that have finally been put out in public. This, if I understand correctly, is the first time that the Empowered Committee is now consulting with industry to get its feedback on what the main architecture of GST will look like. How important are these 4 discussion papers?
These documents are very fundamental because the entire GST administration and compliance architecture depends upon these 4 documents which have been made public by the government. And obviously, there's a lot of information in these documents which public is still trying to digest. And I think we can discuss the overall comment I can make is that while the GST design is not very sort of clean as reflected in the Constitution Bill. So whatever the GST is designed and implemented, its success now depends very critically upon the 4 compliance procedures on which the documents have been released.
Mr. Kulkarni, some of the tax consultants I was speaking to were saying, hey, but this is just really 20% of what, the full GST architecture is going to look like, so it's not really very important. Far more important is what the draft GST bill ought to look like, and that is not yet in the public domain.
I agree with you. The business decisions on certain areas we can take only when the draft act and rules are available. But the point is that the most important process is of compliance, and that compliance has come up. Now in most of the states or central there is a e-compliance, returns, registration, payments. But now first time the government is opening out to the industry what is a correct plan for this compliance. Importantly, registration, returns, refund and so on. So this is a very positive move. Okay, fine. Mr.
Narsimham, a quick comment from you on the import of these 4 discussion papers being put out in the public domain.
These reports are intended to bring certain efficiencies which will lead to the ease of doing the business, and I also feel that align the objectives of Make in India.
Okay.
So certainly we have to gear up for the compliance requirements.
And that's exactly what I want to do. I want to examine whether these reports really do that. So Satya, I'm going to bring it back to you, and I'm going to start first with the discussion paper on registration. Now what I picked out from all my conversations, the most interesting feature in this is that a company will have to register in every state that it has a business presence. What I want from you very quickly are the cons or the challenges that you see in the discussion paper put out.
The most fundamental controversial part of the GST registration document is that it requires registration of a given entity in each state where they carry on business. The moment they register in a given state, for all practical purposes, that registration activity becomes classified as a separate legal entity. Now, this basically fragments the accounting and compliance procedures for given legal entity to multiple states. This is worse than what we have today, because today for the central taxes there is a single registration for a given legal entity. Now that single administration now will be decomposed into each of the states, and there will be no opportunity for pooling of excess credits and excess taxes in 2 different registration numbers in the same legal entity. So which is a very serious retrograde feature of these registration processes.
Okay, Mr. Kulkarni,
I would like to add it here. See, I am going through the process, I am involved in making of this.
Sure.
The states did not agree to that if there is a single registration even for central.
Right.
So that is a final decision they had to make, that each state will have to have a separate registration number.
And Satya is pointing out that that's going to be really difficult for companies to,
but now we have to accept it, because states and central first time coming together, some compromise here and there has to make, and states require this as their own revenue, so they have made this condition and finally they have accepted. So I think we have to go along with this.
The point I like to make is that I understand the state's requirement, but that's really legacy thinking, because they are used to physical control on the taxpayer. Under GST type tax, you don't have to have a registration of each dealer in each state. All you need is that they should be able to monitor the compliance by a given registered dealer regardless of where it is registered.
Here I would like to bring one positive aspect. All the GST registrations are going to be linked with the PAN. I see this is a very welcome step as far as the registration process is concerned.
Okay, but do you think that will help mitigate the fact that you will have to register in every state that you have a business process in, as Satya has just pointed out?
No. Certainly I think that is going to lead to certain cumbersome processes.
Okay. Satya, besides the registration in every state, are there any other challenges that you see in that registration discussion paper that you would like to highlight for our viewers that companies will have to start gearing up for?
Companies now, they have to segment their financial accounts state-wise. So a given legal entity, whether it's Mahindra and Mahindra or Dr. Reddy's, now they have to prepare their financial statements on the basis of each state where they are registered. Now that itself is a Herculean task. The GST registration and return filing procedures require that there will be reconciliation of the taxes, sales and purchases in each state with the sales and purchases and all other expenses reported in the financial statements. More importantly, if you have a situation where you have excess credits in one state registration number and excess taxes to pay in the second state, you cannot pool the two together. So this is going to give rise to a very significant mismatch of the positive and negative balances, which will put a cash flow burden, because government would like to collect the positive taxes, which will not be offset by the negative balances available in a second registration number.
Okay. Mr. Kulkarni, I want your comments on that. What do you make either of what Satya has brought up or other concerns? For instance, while you say that accept state-wise registration as fait accompli, you yourself, I think, have pointed out to me that, you know, in each case, in each GST application form, you have about 70 fields that need to be filled. And if you miss even one field, the registration will be cancelled.
If you are already VAT or service tax registered dealer in the state, but you have to fill the form, though you do not have to submit the physical documents, but even if there is a one error, there are 70 fields.
Exactly.
So there it will be cumbersome, and then they may reject your application. Not in one state, then all states will reject your. Such type of condition should not be there. Some important mandatory things should be proper, others we can revise afterwards. That should be the option should be given.
Mr. Narsimham?
Yeah. So I would like to bring one point here. As per the proposed rules, SENVAT credit cannot be taken if a purchase made from the blocklisted vendor. As per my view, this is very improper. When a buyer made a purchase with a good faith, SENVAT should be allowed.
Okay. In the interest of time, and since we can't resolve any of these challenges here, I'm going to move on to the next discussion paper, which is the one on payments. Satya, I bring it back to you here. What would you highlight as the key things that need to change?
The process they've designed is pretty robust, and it's a standard system that is prevailing today. But my understanding is that there is still friction going on, taking place between the center and the states. They have proposed today that all the payments will flow through the so-called the Kuber system that RBI maintains. The states are not agreeable, I'm told, to the use of the Kuber system. They want a decentralized money tracking system which is other than Kuber system. Now, it should not really have any impact on the taxpayers, but it's still a point of friction.
Okay, Mr. Narsimham, you had a procedural issue here, which is the preparation of multiple challans, as you pointed out, for different states. You would rather have a single challan for multiple states?
Yeah. So here I would like to, under the payment process, one good thing is that all the payments can be made through credit card, debit card or RTGS. I feel this is a welcome step.
Okay.
And here I have two concerns. One is, as per the existing indirect tax regime, all export incentives can be used for the duty payment. But whereas in the proposed rules, this provision is not there. A suitable amendment certainly is required to use the export incentive schemes like MEIS.
Okay.
And the second one, all GST reverse charge payments should be made through cash. I feel this should be allowed to adjust against the input tax credit.
One thing I wanted to add.
Yes.
No mention of payment under protest in the draft, because many payments we make under draft when we go for appeal for litigations.
Right.
So that should also have some place we should put it. So officially it will be recorded that it is under protest.
Okay.
We are not paying on voluntarily.
Okay, that was about payments. I do want to discuss refunds, which is really the most contentious area here, as also returns, but I'm going to do that right on the other side of this quick break. Now let me come to the stickiest issue of refunds, and I know that this is where a lot of the concerns are. Satya, you had a long list of concerns when it came to refunds, especially with the disallowment of refunds automatically, or in cases where, let's say, there's an inventory build-up. Can you elaborate for us where you see some of the weaknesses in that discussion paper?
The most crucial feature of a GST type tax, which can make it an angel or a devil, is the availability of input tax credits. Under GST type tax, frequently input tax credit claims can be more than the output taxes payable. In most modern jurisdictions, there is a prompt refund of any excess input tax credits. Take the example of Canada, Australia, New Zealand. Within four weeks, in fact in some cases in Canada, within 14 days, excess input tax credits are refunded, and the refund is delayed beyond 14 days. You get interest at the market rate of interest. Now what has been proposed in India is really continuation of the legacy system that the states have today. For example, under the state VAT today, there is no refund of tax on account of capital or inventory or any other purpose. For only refunds they provide are for the exports. Now in the GST law, the same policies have been incorporated. There will be no refund of tax on account of inventory build-up, no refund of tax on account of capital. Now a tax credit delayed because of lack of refund is effectively tax credit denied. And if you deny the tax credit, it makes a benign tax system, perhaps one of the best tax systems, into one of the worst. If you think of the example of TOT, turnover tax, a turnover tax is a GST without an input tax credit. Now worldwide, countries have abolished the TOT. The last time any respectable TOT was introduced was 1954. In fact, VAT was introduced in 1954 to replace a TOT by the VAT. Now, under the system that has been designed, first of all, there will be no refund of input taxes if the inputs are going into production of petroleum, electricity, real property, or alcohol and tobacco, alcohol and spirits. In addition, there are many other exemptions. Again, any inputs acquired for making an exempt supply, no input tax credit is allowed. So the whole system is designed to protect the interests of the governments, continue the legacy system, and they have forgotten the interests of the taxpayers.
Okay, let's ask the taxpayers that. Do you feel that this portion is most debilitating?
Yes, very much, because in the VAT regime or in the central government regime, we are finding it very difficult, though there are electronic processes, but still the approvals are the most important factors, where they pay and they years together they don't pay it. So if it has to be out of 10, if 8 are the regular ones, they should give some 2 or some specific, they should hold approval. But for 8, they should okay it automatically refunds. Okay. Otherwise, this system will not work.
And what happens if you're using an input that is exempt, as Satya pointed out?
Yes, that is the again problem. All negative list items, petroleum, it's a cost to us.
Yeah. Mr. Narsimham?
So whatever points raised by the Poddar and the Kulkarni, I completely agree. Apart from that, I would like to bring one more point. I think here, submission of BRC. I feel that this is going to be very cumbersome. As per existing excise rules, a refund application can be submitted to the excise authorities and refund can be obtained within a specific time period. Whereas as per the proposed rules, for every refund application, the BRC is a mandatory condition. So this will lead to the funds blockage and resulting into the higher working capital and additional interest cost burden on the assessees. A suitable amendment should be brought in as far as this process is concerned, or the existing rules can be continued.
Okay.
Without insisting the BRC.
Okay. In the interest of time, I'm going to move on to the last discussion paper, which is on returns, and ask you all very quickly to contribute what you think your key concerns are. I'll start with you first, Mr. Kulkarni. On the returns front, do you have many issues here?
See, return first, the important thing is of the tax credit system, which they have not come out clearly, very elaborately so far, because all it is connected with your IT support. And if they come out with certain clarification on some issues with regard to taking the input tax credits under GST, it will be very useful, because that will be the most critical part of it. Otherwise, the things are okay that way.
Okay. Mr. Narsimham, your thoughts on returns?
So here also there are several returns, almost I think 8 returns are prescribed.
Yeah.
I feel that a simplification is required here, otherwise this will lead to the huge manual work and cumbersome processes.
Okay, fine. Satya, I'm going to ask you for your thoughts on returns, but what I'm also going to do is to ask you to broaden that comment into how you assess this glimpse of GST architecture that we've finally been able to get. And when you combine that with what you expect to see in the draft GST bill, what kind of GST will India be bringing about?
Well, as far as the tax returns are concerned, the most crucial feature of the tax return filing is that they are requiring pre-validation, almost cross-verification of input tax credit invoices. And this was a conscious decision taken by Nandan Nilekani, that the biggest, the most critical feature of the foundation for the creation of this institution of GSTN is proper validation, because all the frauds that take place abroad under GST type tax are based on false claim of input tax credit based on false invoices. Now, the system relies upon immediate cross-verification between the buyer and the seller that a particular purchase invoice for which an input tax credit is being claimed is properly reported as a taxable sale by the vendor. So this is a very good feature. At the same time, it makes the system somewhat cumbersome. And I'm personally of the view that it is worthwhile to pay the price of a cumbersome system, provided the complexity of the cumbersome nature is needed to protect the integrity and stability of the tax system over time. But the main problem is that they're designing such a cumbersome and robust system, but they are not giving the benefit of that cumbersome system by giving prompt refunds of the tax to the taxpayers. Because only reason for doing cross-verification of input invoices is so that the refunds can be processed very promptly, because once the invoices are processed and verified, why should the refund be held back? The second concept is that overall, these are still discussion documents, and my understanding is that the center is very sympathetic to the taxpayers, and but the states have been very adamant in essentially carrying over their legacy systems. The most fundamental feature of a good tax administration in a modern jurisdiction is that you require control of information, reporting of the sales and purchases by the dealers, and not physical controls on the dealers themselves.
If I may conclude for you, you sound fairly unhappy, if I may say so, or dissatisfied with these 4 discussion papers. God forbid we have a revenue neutral rate of more than 20% and a longer exempt or negative list, and you're going to be fairly critical of this GST design.
Well, to be honest with you, I still look at these documents as consultation documents, and I'm really hoping that there's still an opportunity for improving these.
Mr. Kulkarni, last word.
I think after a long time, everybody showing the positiveness, government is also looking at it. So as an industry person, I want, even if it is a VAT plus, not the complete GST, it should come, because many of the problems would be solved rather than again complicating.
You don't mind the logistical issues and all the other issues we've discussed
all the
today.
processes we have seen over the years, whether excise, VAT, they get improved upon. But if you want to make the best thing at the first time right, it will not happen.
But if you had all this in a revenue neutral rate of 26.7%?
Yes.
You'd be okay with it?
Not 27, 24 is okay.
Well, that's what the Empowered Committee had suggested. The government, I think, has said that they will look at something
We will have some other debate on when the rates are
on the rates. Okay. Mr. Narsimham, last word to you. Is this effort going to be worth it? Is GST going to be worth it if it comes in this design?
No. One point I would like to make is, if the rate is beyond 20%, I feel like it is going to lead to a lot of cash outflows for the companies. And one more point I want to bring here, that 1% additional tax on the stock transfers will lead to the additional impact on the assessees. As far as pharma industry is concerned, I would like to bring one today, as per the existing laws, there is inverted duty structure is there, a higher duty for the bulk drugs and formulations, a lower rate. This is leading to the accumulation of the SENVAT credits. So here, either the rates have to be harmonized, or a simple process to be brought in to get the refund quickly.
Okay, gentlemen, I'm entirely out of time. I'm going to thank all three of you for joining us on this show, and I do hope that the Empowered Committee, the Joint Committee and the government is listening very closely to the feedback that you're sending them, so that we can have a vastly improved GST design. Thank you to all three of you for joining us, and thank you very much for watching Godspeed GST. We're going to end on that note. We'll see you next week.
The Firm, India's only show on corporate law, tax and audit matters.